If you opened your trading terminal this morning expecting the continuation of the euphoric rally we've seen over the last few months, you were likely met with a sea of red that felt less like a correction and more like a crime scene. Gold futures have slid violently. Silver futures have not just slid, they have collapsed, echoing the darkest days of historical volatility. The screens are flashing numbers that defy the fundamental reality of the world we live in. Gold spot fighting to hold 4,191. Silver struggling in the low 80s after looking ready to conquer $100 just days ago. Related assets like GLD, SPDR Gold Shares, and SLV, iShares Silver Trust, are bleeding out, dragging portfolios down with them. For the uninitiated, this looks like the end of the bull market. It looks like the thesis was wrong. It looks like the safe haven asset class has become the riskiest bet on the board. But if you look closer, if you strip away the panic, ignore the screaming headlines, and look at the mechanics under the hood, you will see a very different story. You will see a market that is not breaking, but resetting. You are witnessing a great deleveraging, a moment where the market violently expels the tourists, the gamblers, and the over-leveraged speculators to clear the deck for the next phase of reality. In this extensive report, we are going to dissect exactly what is happening to gold and silver prices today. We will analyze the collapse in copper, the carnage in mining stocks, and the disconnect in the Indian physical market. We will answer the burning questions. Why is gold down? Why did silver crash? And most importantly, we will lay out the 5 realistic scenarios for what happens next, providing you with a roadmap to navigate this volatility without losing your position or your mind. Section 1. The crash data points. Snapshot of a market in chaos. Before we dissect the why, we must confront the what. In fast-moving markets, confusion is the enemy. Prices vary by exchange, timestamp, and liquidity provider, but the trend across the board is undeniable. Here is the battlefield assessment as of early Eastern Time, ET, trading on this turbulent Monday. 1. Gold, the king under siege. Spot price, hovering around $4,191 per ounce. The significance. Just days ago, we were printing record highs. To see intraday prints dipping toward $4,700 suggests that major technical support levels are being tested. This isn't just profit-taking. This is a liquidation event where stop losses are being triggered in a domino effect. Futures market, trading in the high 4,600s to low 4,800s. The spread. The variation depends heavily on the contract month. Front-month contracts are taking the hardest beating as speculators rush to exit, while further-out contracts are showing slightly more resilience, indicating that long-term sentiment hasn't fully evaporated yet. 2. Silver, the high beta heartbreak spot. Price, roughly low 80s per ounce. The context, silver is down significantly more than gold in percentage terms. This is classic silver behavior, which we will detail later. A drop to the low 80s from the recent highs represents a massive destruction of paper wealth in a matter of hours. Futures market, broadly in the mid-80s, but with extreme volatility. The whipsaw. On some contract screens, bid-ask spreads have widened and price gaps are visible. This indicates a liquidity air pocket, a situation where there are simply no buyers at certain price levels, causing the price to teleport lower rather than drift lower. 3. The industrial canary, copper price, around $5.70 per pound. The signal. Copper is often called Dr. Copper because it has a PhD in economics. It signals industrial health. The fact that copper is down from last week's highs confirms that this isn't just a monetary sell-off. It is a broad-based risk-off event where investors are fearing a global economic slowdown or a liquidity crunch. 4. The paper proxies, GLD and SLV GLD stock, indicating 445s, SLV stock, indicating $75. The reality check. These ETFs are where the retail investors live. When you see SLV at $75, you are seeing the panic of the average investor who bought in at the top, thinking the line only goes up. The heavy volume in these ETFs is exacerbating the sell-off in the underlying futures market, as authorized participants, APs, are forced to sell metal to balance the heavy outflows. The plain English summary: gold is down significantly. Silver is experiencing a localized crash. The term silver crash today is trending not because the metal is useless, but because the price action is violent. Investors are reassessing how much of last week's vertical move was driven by actual supply-demand fundamentals, and how much was just a mountain of leverage that is now collapsing. Section 2. Why is gold down today? The unholy trinity of commodity sell-offs. To understand why an asset with a 5,000-year history of value can lose 5% or 10% of its purchasing power in a single trading session, you have to stop looking at gold as a rock and start looking at it as a financial instrument traded by algorithms and leveraged hedge funds. The drop today is not a mystery. It is the result of a familiar trio of market forces that punish greed. 1. The mechanics of leverage and margin pressure. This is the single biggest factor. Over the last month, as gold broke $4,500 and raced toward $5,000, fear of missing out, FOMO, kicked in. Traders didn't just buy gold, they bought futures on gold. They bought options on gold. When you buy a futures contract, you might only put down 5% or 10% of the total value. This is the margin. The upward spiral. When the price goes up, your gains are magnified 10x or 20x. It feels like magic. The downward death spiral. But when the price drops just 2% or 3%, your entire equity is wiped out. On Friday, when the initial pullback started, brokers issued margin calls. They told traders, deposit more cash immediately, or we sell your position. Most traders didn't have the cash. So, the brokers forcibly sold the positions. The loop. This forced selling drove the price down further. That lower price triggered more margin calls for the next tier of traders. This created a self-reinforcing liquidation cycle. What you are seeing today is not people selling because they hate gold. It is people selling because the computer is forcing them to sell to pay their debts. 2. The dollar strength and rate repricing. Gold is priced in US dollars. There is an inverse mathematical relationship that algorithms are programmed to exploit. The DXY surge. The US dollar index, DXY, has strengthened significantly in the last 48 hours. Why? Because the market is repricing interest rates. Real yields. If the market believes the Federal Reserve, perhaps under new leadership or pressure, will keep interest rates higher for longer to fight inflation, the real yield, interest rate minus inflation, rises. Gold pays no interest. It has no dividend. Bonds pay interest. When yields rise, institutional money rotates out of non-yielding assets, gold, and into yielding assets, bonds, cash. This rotation puts mechanical pressure on the price. It makes gold expensive for foreign buyers holding yen, euros, or rupees, further dampening global demand. 3. Crowded positioning. Unwinds. Wall Street has a saying, when everyone is on the same side of the boat tips over. Last week, everyone was long. the sentiment was 98% bullish. Hedge funds, CTAs, commodity trading advisors were loaded to the gills with long positions. Risk management. Professional risk managers at these funds have strict rules. If volatility spikes, which it did, they are mandated to cut exposure. It doesn't matter if the fund manager loves gold personally. The algorithm says volatility is up, position size must go down. The stampede. When huge funds try to exit a crowded door simultaneously, the price crashes. The immediate priority becomes reducing volatility, not capitalizing on value. Section 3. Why is silver crashing? Understanding the devil's metal. If gold is the prudent king, silver is the volatile jester. The question, why is silver dropping today, has a more aggressive answer than gold. Silver is sliding deeper, faster, and harder. Here is why. 1. The beta problem. Silver is essentially gold on steroids. It typically moves 1.5x to 2x as much as gold in either direction. In a rally, this makes you rich. In a correction, this wipes you out. Silver attracts high beta speculation. The traders involved in silver are often more aggressive, using higher leverage than gold traders. When the market turns, these aggressive traders are the first to be liquidated. 2. The thin market, liquidity crisis. The silver market is tiny compared to gold. The entire annual supply of silver is worth a fraction of the gold market. The consequence: it takes very little money to push the silver price up, but it also takes very little selling pressure to crash it. Gapping. Today, we saw gapping. This happens when sell orders hit the market, and there are literally no buy orders for 50 cents or $1 lower. The price simply falls through the floor until it finds a buyer. 3. The industrial disconnect. While gold is monetary, more than 50% of silver is industrial. Solar, EV, electronics. During a risk-off event, like today, traders fear a recession. If there is a recession, they assume fewer solar panels and iPhones will be made. Therefore, they short silver as an industrial metal, ignoring its monetary value. The verdict: the silver crash is not a structural failure of the metal. It is a liquidity event. Forced selling met a thin market, and the unwind fed on itself. This is a feature of silver, not a bug. It punishes the over-leveraged to reward the patient accumulator. Section 4. The view from India: physical reality versus paper delusions. While Wall Street panics, Main Street in Mumbai and Delhi is looking at a different calculator. The gold price today in India and silver rates tell a story of divergence. In India, the price is not just spot X exchange rate. It includes import duty, GST, and the local premium. Current Indian reference rates: Feb 2, 2026. 24 karat gold, Rs 15,153 per gram. 22 karat gold, jewelry standard, Rs 13,190 per gram. 18 karat gold, Rs 11,365 per gram. Silver, Rs 300 per gram, Rs 300,000 per kilogram. The divergence: usually when global spot prices crash, physical demand in India and China explodes. Indian buyers are famously price sensitive. They wait for these dips. Watch the premium. If the global price stays low, but the price in India doesn't drop as much, it means premiums are rising. Dealers are charging more over the spot price because physical metal is scarce. The floor. This Asian physical demand acts as a hard floor for prices. Paper traders can push the price down, but if physical metal starts draining from vaults to flow to India at these lower prices, the COMEX, futures exchange, runs the risk of a delivery failure. This arbitrage prevents the price from going to zero. Section 5. The psychology of stakeholders. Who is selling and who is buying? To predict the next move, You must understand the players at the table. The weak hands, retail and momentum traders. Status, panic selling. Mindset. They bought SLV at $90 because a YouTuber told them it was going to the moon. Now they are seeing 20% losses and are selling to save what's left. They are providing the liquidity for the big players to buy. The machines, algos and systematic funds. Status, auto-selling. Mindset, they have no feelings. The math says, trend broken, so they sell. They will continue to sell until volatility stabilizes. The physical buyers, stackers and sovereign nations. Status, waiting, nibbling. Mindset, central banks and long-term stackers do not chase spikes. They wait for crashes. They are currently watching the premiums. If the price drops another 5%, expect massive tonnage to move from west to east. The ETF tourists, GLD, SLV holders. Status, unpredictable. Mindset, these flows create noise. If mainstream media screams gold crash, these investors sell, forcing the ETF to dump tons of metal into the market, deepening the slide. Section 6. What happens next? 5 realistic scenarios. We are at a crossroads. The charts are broken, sentiment is crushed, but fundamentals remain. Here are the 5 paths forward, ranked by probability. Scenario 1. The stabilization bounce. Probability, high. The setup. The selling pressure simply runs out of steam. Everyone who needed to sell, due to margin calls, has already sold. The trigger. Prices hold a key technical level, e.g., gold 4,750, for a full trading session without breaking lower. The result, a sharp fast bounce, dead cat bounce, followed by a period of boring sideways trading. This allows moving averages to catch up. Scenario 2, another liquidation leg, probability medium high. The setup. The volatility scares away new buyers. The buy the dip crowd gets punished, so they stop buying. The trigger. Fresh margin calls hit the Asian and European markets overnight. The result, we see one final sickening drop, a capitulation. Gold might test $4,500. Silver could momentarily pierce $70. Note, this is often the absolute best time to buy for long-term investors. Scenario 3. The dollar reversal relief rally. Probability, medium. The setup. The macro data flips. Maybe US unemployment numbers come out higher than expected, or inflation looks lower. The trigger. The dollar index, DXY, drops sharply. The result. The mechanical pressure on gold lifts. Prices snap back to pre-crash levels almost instantly as the Fed pivot narrative returns. Scenario 4. Wide-range trading. The meat grinder. The setup. The market is confused. Mixed signals from the Fed and the economy. The result. Gold bounces between $4,600 and $5,000 for weeks. This is the most frustrating scenario because it chops up traders on both sides. It is designed to bore you out of your position. Scenario 5. Silver-specific snapback. The V-shape. The setup. The short interest in silver becomes too high. The trigger. A massive short squeeze. The result. Silver falls to 75 and then rockets back to 90 in 48 hours as shorts scramble to cover. This is common in silver, but requires a specific catalyst. Section 7. The strategic playbook. How to position yourself. Now you are not a hedge fund. You do not have daily reporting requirements. This is your advantage. You can afford to be patient. Check your leverage. If you are trading on margin, reduce it now. Do not try to be a hero. The market can remain irrational longer than you can remain solvent. Survival is the priority. Ignore the noise. Do not make decisions based on the red numbers on your screen today. Make decisions based on your thesis for 2027 or 2030. Has the US debt disappeared? Has industrial demand for silver vanished? No. Watch the ratios. The gold-silver ratio has likely spiked, meaning silver is cheaper relative to gold. If you are looking to deploy fresh capital, silver technically offers the better value proposition here, albeit with much higher risk. Physical versus paper. If you hold physical metal, do nothing. Close the app. Go for a walk. Your ounces are still ounces. They weigh the same today as they did last week. This price drop is a paper phenomenon. The buying opportunity. If you have dry powder, cash, wait for stabilization. Don't try to catch the falling knife today. Wait for the market to close. If we see a long tail on the candlestick, price dropped and recovered significantly, that is your signal to enter. Conclusion. What we are witnessing in the gold and silver markets today is not the death of the bull market. It is a stress test. The market is asking you a question. Do you really believe in this asset? Or were you just here for the easy money? The leverage is being flushed out. The weak hands are folding. The media is writing obituaries for precious metals, just as they have done 1,000 times before. But remember, wealth is not destroyed in these moments. It is transferred. It transfers from the impatient to the patient, from the leveraged to the liquid, from the reactive to the strategic. The price of gold is down. The price of silver is crashing. But the value remains untouched. The fundamentals of debt, debasement, and demand have not changed. Only the price of admission has. And for the savvy investor, a lower price of admission is not a crisis. It is a gift. Stay disciplined, stay liquid, and keep your eyes on the horizon, not the potholes.